Hello, everyone. Thank you so much for joining us this evening. I know it's a Thursday evening. Luckily, it's not raining outside, so hopefully it was easier. We were a bit worried earlier in the day. But thank you so much for choosing to spend the time with us. We have a small agenda today that I'll quickly walk you through. But first, maybe just quickly as an introduction, I'm Nandini. I'm the Deputy CEO at StashAway. I also have a few of my colleagues over here who afterwards, feel free to ask them questions. They are from our client engagement as well as advisory teams, so they are always happy to help and answer any questions. But what we want to talk about today is cash management. And quite soon I'll also invite experts who have kindly agreed to join us today from Lion Global and Nico AM. So hopefully you will really get some great insights today, as well as answer some of your own direct questions. So feel free to at any point, share with us. Okay, so I know everybody is eating, but if you want to just very quickly use your phone, we'd love to get to know a little bit about your thinking and all, so that it also helps us tailor this a bit more. So where are you currently investing your cash? I'll leave it up for another 3 seconds before I move on. So while you also look at answering that, maybe, I think, moving forward. I can't move it forward. Can you move to the next one? So just if everybody doesn't know who we are, I'll just quickly share. So we are at StashAway. We are a digital wealth management platform. Our mission is really to bring intelligent investing in a simple, cost-effective manner. We think, we believe there are some very basics of investing, like diversification, like having access to the right investing instruments that helps everybody, and that has been made complicated in the past, and our mission is really to simplify that. While we are what we call fully digital, but as you can see, we have some colleagues over here. There's always somebody at the end of a phone line, WhatsApp, or email to always answer your queries. But we've been very fortunate to be supported by some of the biggest investors in the world, like Sequoia, Hamilton Lane, so people coming both from the tech world as well as from the investment world. We are regulated in 5 countries. Singapore is our home base, what we call. We started here. But we are also regulated in Malaysia, Thailand, Hong Kong, and Dubai, and so have offices and clients over there as well. So we're not going to obviously touch on everything, but just to give you a quick flavor, what we do is our core portfolios, which are based on our own investment strategies, but as well as cross-referencing with investment strategies of other fund managers. So we have BlackRock portfolios as well. That's part of our core investment as well as passive income. And then we supplement this with cash management investment strategies that are available to our clients in all of the countries, which is where we will focus on today. Apart from that, we also have thematic portfolios and then offering for accredited investors only in the space of private markets. But today, what we are gonna really talk about are how to grow and effectively manage your money in the short term. We all hold cash, and we'll talk a little bit about how much cash in Singapore we all actually keep. But we'll talk a little bit about what solutions are available, and then also a little bit of insights around, what are going to be impacting those yields for cash management so that you can make informed decisions. So this is a data that, we look at it from time to time, and it always surprises us, especially when we put it in the context of other, for nations as well. On average, in Singapore, a person holds over $88,000 in cash in bank deposits. That's a lot of money in cash. It's among the highest among, some of the more advanced economies. So, comparing it to Hong Kong, Korea, Taiwan, and actually this number, usually around the Australia and Australia number is what US stays. But in Asia, even among the advanced economies, Singaporeans tend to hold quite a high amount of cash in their bank deposit, and that's why for us it's really important to do these sessions and bring perspective to people on how to make sure that that money is not sitting idle. And that money stays usually in your low-yielding accounts. I'm sure I don't need to share with anybody what savings accounts pay in Singapore. So hopefully today will help you out with getting not just a little bit but a lot better out of those savings. So on an average, in Singapore, people hold 20% of their net worth in cash. That's quite a big number because a high net worth individual holds 9% in cash. That's the allocation of when somebody is really getting a financial advisor full-time managing their money, is optimizing it for holding only 9% of their net worth in cash. This is not to say that we should be reducing it, but it's something for us to be aware of and understand what could be better solutions for us, while, if that 20% is what makes us comfortable holding our money in cash, then that's what we need. So a few things that, we usually, from an advisory perspective and from a golden rules perspective at StashAway, we always recommend to our clients is from an expenses, leaving money really in your bank account, try to limit it to 1 to 2 months of expenses. Anything more than that, we consider it as excess cash, something that you shouldn't be leaving at 0.05% interest rate in a savings account. An emergency fund, which is really important. I know a lot of people like to name it differently, whatever helps you, but anywhere between 6 to 12 months of your expenses. Some people are very comfortable keeping 6 months. I have 2 kids, their school fees is a bomb. I have to, 12 months is something that I feel more comfortable about. And so, my own emergency fund tends to be a little bit higher. But, it's to, again, make sure that you feel safe, you feel covered, and, you are not having to think about your money all the time. But what you don't want to do is, leave it just sitting in a 0.05% bank account, because it is meant for emergencies, and touch wood, hopefully we won't have to use it. And so in that time, we do want to think about how to optimize it. And that could also be for goals that you might have in the next 6 months, 12 months, a travel goal, or even within a shorter time period, anything which is below 3 years, we consider that largely under cash management strategy. Why? Because you want to keep this money liquid. That's what you care about. If you have expenses, if you do have any emergency, you want to utilize the money, you want that there is liquidity. You want that it's in low risk. Seeing your emergency fund going through the ups and downs similarly to an S&P 500 is, not something most people can stomach, and that's not what that money is meant for. So ensure that, it's in low risk, but it still needs to beat inflation because you are leaving there for quite a longer time. Any interest, even within a low risk that is not beating inflation, is still drawing down on your money. So this is why we talk, a lot about cash management solutions, because this does tend to be quite a big part of our net worth. And while on a day-to-day basis, it might not seem like it moves the needle so much, but when you accumulate it over 5, 10, 15 years, it actually does start to move the needle. So maybe a quick one, if you still have your phones in your hand, of what for you is most important in your cash management solution. We can share the results after. Okay. So just to set the stage, because we have experts from Lion Global and Nico Asset Management to share details with us today about the funds, but just to share a little bit in terms of how those funds are actually put into solutions so that you can have context to the discussion later on, but also, you can then get your own questions answered as well. So, we have 3 cash management solutions within StashAway, and they all work towards, on the axis of liquidity, low risk, and, rates that beat the inflation. And how we construct them is something important for everybody to understand, because not all products are meant for any type of purpose. So our first one is StashAway Simple. It's something that we launched in 2019 when the interest rates actually used to be sub 1%, and the underlying funds for it are money market funds. And basically, what we wanted to do was just make it very, very easy to access an instrument that is very well used by institutions, a lot of sophisticated investors to manage their cash well. So we'll go a little bit more deeper with that with the experts, but what is most important is that the liquidity, we ensure that in cash management solutions, the liquidity is paid attention to. So this is 1 to 2 business days. And then, in this product, for example, there at a weekly level, there has never been a drawdown. And that is really important to know what actually has been the historical drawdown in any product that you want to consider, and whether that's suitable for your cash or not. And this is, we'll share later, this is really because of the structure of the funds that we utilize as underneath. But we ensure that it is maximized for that risk. The returns are maximized without taking on any extra risk than what your immediate cash should be meant for. So it's great for when you want ultra high liquidity and ultra low risk. And it has never had a week of negative returns since inception. So this is just, we share this also on our website and also to clients. So the second one is Simple Plus. This is slightly higher risk because, as you can see, along with the liquidity fund, there are some short-term bond funds that we introduced in this. Now, the purpose for this is because we always have cash that, we keep. We say it's not really meant for investment. It's meant for maybe a little bit more than 1 year, anywhere between 1 to 3 years. And therefore, your time horizon means that you can think about adding in some allocation, some instruments like short-term bond funds that can provide you that extra yield, but not take on excessive risk again. And so here, this is not something that we recommend for cash that you need within 12 months because of the exposure to short duration bond funds. There may be a little bit of volatility in it. But as you can see, the max intra-month drawdown of this product has been 0.82%, and therefore it still stays in the ultra low risk realm. But again, simple before that you saw is even lower risk, and that's just because it's 100% in money market funds. The liquidity over here is 2 to 3 business days because the bond funds underneath, they require about 2 days, for us to transact with. And, while the yield may look a little higher, 3.1 versus 3.6. That's not the only top number to look at, but really make sure that you understand what it is meant for and what is the time frame for which it is best for. So for example, as you can see, on a month-by-month basis versus what I had shared earlier for the simple product, while in the last 12 months it hasn't had, a month of negative returns, in other times, when in 2022, when bonds had gone down as well along with equities, also short-term bond funds did go down a little bit, but obviously, our job is to manage that asset allocation effectively for you so that the risk-adjusted returns still make sense. But, on a monthly basis, the returns obviously fluctuate a lot more, and this is why this is really meant for an over 12 months period. And then we have simple guaranteed, which is, the underlyings are fixed deposit with banks. I don't think anybody needs for me to explain. But again, the rate is based on the tenor. And here, obviously, you are swapping liquidity, a fixed term liquidity for the guarantee of the returns, whereas the other returns are projected returns. And then, some of us also in Singapore, tend to hold some USD as well. So we do have a USD cash yield portfolio, which is a very simple, exposure to US Treasuries under 3-month maturity, and that again is very stable and ensures that there is not excessive risk. But again, obviously, this is not meant for short-term cash needs because, first of all, you are moving money into another currency. But if you already have USD, then you are not introducing a currency risk in it. But moving from SGD, you obviously introduce a currency risk as well. Okay, but this is from us. What else exists there? Obviously, for us, the most important thing is please don't leave excess money in the savings account. It is not working for you. It's working for the banks. That's how the lending books are built. So, make sure that, that your money is paying interest to you first before to anybody else. You also have T-bills. Singapore government securities bonds, SG savings bonds. These are very, very popular instruments in Singapore, and for the right reasons. They are backed by the government, they are secure, but where, we think we solve problems for our clients is on the convenience aspect. You don't have to go through auction processes and all, and we try to ensure that our cash management solutions are effective against, just as safe solutions out there. But these are some of, the popular solutions, obviously, in Singapore. And then the last is, fixed deposit in bank accounts, which are a lot promotional driven as well, so you have to continuously look for those promotions. And probably one of the reasons why, in Singapore we all hold multiple bank accounts, which is not very common in a lot of other countries. So I will stop there, and I'll invite Bertram and Chote from Lion Global, and please.
Thank you.
So maybe very quickly, we have Tochie from Lion Global, and we have Bertram Sarmago from Nico AM. If you don't mind to quickly introduce yourself, the fund house, and the funds that today we are talking about here, if you can just introduce the funds as well.
Right. Okay, thanks Nandini. A very good evening, everyone. Thank you for coming here. Thanks StashAway for inviting us. My name is Tochie. I'm head of fixed income at Lion Global. Lion Global, we are part of the OCBC group. I'm sure all of you know who OCBC is. We're owned by OCBC through Great Eastern. We do manage part of Great Eastern's money, and therefore we do run a rather large book of fixed income products. I think Nandini showed earlier some of our products out there. So from Lion, we have the money market fund, the enhanced liquidity fund, and the short duration bond fund. I'll just quickly go through all of them before I hand over to Bertram. Money market fund and short enhanced liquidity fund are both similar, except in name. In Singapore, if you call a fund money market fund, you need to abide by certain rules. And one of the stringent rules is you need to have X amount of cash. In our case, our money market fund, we need to hold 20% cash. So if you call yourself money market fund, you need to abide by MAS's rule. So when we had that fund, it was doing well, but then along the way, there was a period when interest rates were very low. And our investors were saying, how do we get better yield while still keeping the product safe? This was the genesis of enhanced liquidity fund, where in form, it's very much a money market fund, but we do not call it a money market fund, so that MAS doesn't have to come after us and say, hey, where's your cash? We do obviously manage our risks, right? And we do manage the liquidity point of view by holding very liquid MAS bills, for example, which I can liquidate T+0 or T+1. But the point is, we can keep the fund liquid, but get a slightly better yield. Now, these were the days when yield curve were normal, meaning that if you take a bit more tenor, you get higher yield. Today, the UK is very flat. The yield curve is very flat, which is why today, money market fund and enhanced liquidity fund, the yield is very similar. It's 3.39 and 3.4 something. But in time to come, as the yield curve normalizes, we do expect the differential to increase. Okay, so that's for Simple, where we have money market fund and enhanced liquidity fund. In Simple Plus, the addition is my short duration bond fund. It's a credit fund. It takes on credit risk. We buy maybe up to 5 years of bonds, BBB bonds. The average duration is actually 2 years, so that's pretty safe. Maybe I'll stop here and hand over to Bertram.
Thanks so much, Bertram. Thank you.
Good evening, everyone. My name is Bertram. I'm with Nico Asset Management. So I'm talking about here Nico AM, the short-term bond fund. So this fund has been in existence since 2000. It's legacy from DBS Asset Management. And so we've been managing these funds for 25 years now. And Nico AM took over DBS Asset Management in 2011. So most of our Asian fixed income team out of Singapore, most of us came from DBS Asset Management. So having said that, our head office is out of Tokyo, but we do manage Asian fixed income strategies, including this fund out of Singapore. So we have a team of 15 fixed income and credit analysts out of Singapore, investing in Singapore bonds, investing in Asian fixed income, both local currencies and dollar-denominated bonds. So for this fund that we have, the Nikko AM Short-Term Bond Fund, this is our enhanced cash kind of product, wherein we add yields or spreads from investing in corporate bonds. So this can be denominated in Singapore dollar or in US dollar or even in Australian dollar to add yield or spreads into the usual government risk-free rates. So in current market pricing, you have government bonds giving you around 2.6, 2.8. Our credit bond funds will have around 3.6 to above 4%, depending on the kind of bonds that you have, depending on the tenor, depending on the credit rating. So this fund really invests in short-term bonds so that you're not so much exposed to interest rate volatility. And then in terms of credit quality, we really focus on high-quality investment-grade issuers and ensure that our average credit rating is A-. So we don't hold non-investment grade bonds.
Thank you so much to both of you for that introduction. So maybe to dive in, the money market funds and the short-term bond funds might be a little bit new as a concept to some people. So if you can share, what are the basic principles of a money market fund? Where are the investments really made, and how do you think about the duration within those investments?
So for our money market fund, duration is really short, right? Our duration is like 0.2 something. So that's something like a 3-month tenor. So that's akin to putting into a 3-month deposit in that sense. But however, the portfolio is really a pool of securities. The rating is better than A, is A+. Now, let me explain. Each of the individual bond that we buy for money market fund, it must be at least A-, right? And of course, we invest all the way to AAA, meaning like MAS bills. So therefore, my average credit rating is definitely much better than A-. The enhanced liquidity fund, however, it's a little bit more lax. At the portfolio level, is A-. So there's a bit of a difference. In terms of securities we buy, like I said, we buy really short-dated stuffs. Single A is considered very high quality. Until recently, we've been buying a lot of MAS bills because MAS bills have been very attractive. That said, that game seems to be going away. Today, MAS bill yields have been dropping. I'm sure you know, you guys are, I saw up there, some of you guys buy T-bills. And as you know, T-bills today is giving you 2.7. MAS bills yields are slightly higher than that. So today it's about 2.8. So that's also coming down. So because of that, we then have to switch to short-dated credits. So we buy, let's say, a 3-month or 6 months corporate bonds. Bertrand mentioned that we do have to buy non-sync because you need to widen your universe. But of course, we hedge it back because we do not take any currency risk. For that matter, for all the funds we mentioned, I believe the same for Nikko. We don't take any currency risk. So that's, in general, the gist of money market funds. We keep the duration very short. We keep the quality very high, keep it liquid, but keep the yield better than fixed deposits.
And if you can explain short duration bond funds a little bit.
For us, the short-term bond fund that we have, our investment universe is wider than a money market fund. So we buy from a 1-month corporate bond to as long as a 5-year bond. So at most within our universe, the final maturity or the next call date of the bonds that we hold is maximum of 5 years. From a portfolio basis, we usually at least target within 1 to 3 years of duration. So the average duration of the whole portfolio will be around 1 to 3 years. Historically, we've been more on the conservative side. Currently, we have 1.5 years of average portfolio duration. During the height of the inflation risk in 2022, the duration was lower at 1 year. So that's where we are in the duration spectrum. And on the credit spectrum, we are investing in from AAA Temasek bonds to BBB, BBB-. rarely do we go into non-investment grade or the double B plus kind of bonds. So really focusing on the investment grade bonds only to ensure we avoid defaults and all that kind of risk.
So maybe, Bertram, staying on that duration part, you said, you look at 1 to 3 years. What are the factors that actually make you move the duration longer? And at that time, what is the impact on anybody who is holding those bonds? Like, how should they be thinking about their duration?
So I think from a simple explanation on duration is a measure of interest rate risk sensitivity. So the higher the duration, the more volatile a bond can be in terms of interest rate movements. So when interest rates are going down, that means that bond prices will go up. So we would tend to increase our duration so that we can enjoy the returns from interest rates going down. But in an environment where interest rates are going up, like when inflation was going higher in 2022, we do tend to reduce our duration so that the sensitivity of our portfolio is not as high as a high duration bond. I think a pure example would be a 10-year bond. Let's say a 10-year bond with a 10-year duration. If interest rates go down by 1%, that bond will appreciate in price by 10%. But if I only hold a 1-year bond, the appreciation will be just 1%. And so it's the reverse when interest rates are going higher.
And in money market funds, how do you view the change in duration? Do you out of the 3 months, does it ever change, and on what factors?
We don't typically change duration for money market funds because it's not meant to, I would say, trade based on duration. Our objective for money market funds is really to keep the volatility very low, but just to get the slightly better interest rates. So really is really to find a better place to park our money rather than to go for that duration. So typically our duration don't move a lot. If we do move, it's really with the view of getting a better yield. If I could, at this point, since we're talking about duration, interest rate movements and price movement of bonds, for the two funds, money market fund and enhanced liquidity, the way we value the bonds is by this method called amortized cost. So if I were to buy let's start with FD. Imagine I place my money into a 3-month FD. 1 month later, how do we price it? So the way we price it, we simply draw a straight line in the sense you just accrue. So you place at, let's say, 4%, you just price it as if you earn 4% every day. We do that for the bond investments in these two funds, the money market fund and enhanced liquidity fund. So for all the investment we do, we'll just lock in the yield at the point of purchase and price it based on that straight line, which is why your NAV won't drop. It's just a straight line towards maturity.
Yeah, and it's one of the reasons that you actually see that daily number moving up in Simple, because it's the amortized rate.
And rightfully so, because it's so short that it doesn't, your interest rate movement, it doesn't quite affect your 3 months papers.
So maybe just to understand, both in money market fund and even, when you look at it from the enhanced liquidity fund perspective and short-term bonds perspective, what are some of the economic factors that you pay attention to that actually, people would be good to be aware of, that these are really the bigger economic factors that matter?
I think from our perspective, we always look at, when you buy bonds, you have the rate level there, which is the base rate is government risk-free rate. And what are the factors that impact government risk-free rate? One is monetary policy, where the U.S. Fed is, or maybe even MAS is controlling currency, but where interest rates are heading from a monetary policy perspective. The reason why interest rates are being taken higher or taken lower is to manage inflation. So you also look at inflation. Where is inflation heading? So during the period where we had high inflation, monetary policy interest rates were being taken higher, so to address the inflation issue. So when interest rates are going higher, then your bonds may perform negatively. So that's what we look at, monetary policy, where inflation is, and also where the economy is in terms of growth. So that's primarily the main factors that we look at. Other factors that you look at will be fiscal policy, where interest rates can go higher because a country will be borrowing more bonds, so that's fiscal. In Singapore, it's not so much an issue because the country has a lot of fiscal surplus, but for US interest rates, that can have an impact on interest rates because of fiscal can impact interest rates negatively. So primarily we look at monetary policy, where growth and inflation dynamics is, and where the interest rates are heading from that perspective.
Yeah.
On the credit side, it's where the fundamentals is to check and add on the credit side, but because I just talked about government bond rates, on the credit side, that's the added yield that you get from investing in corporate bonds. So you have to look at the credit quality of those issuers that you buy into. AAA bonds, lower credit spread, but if you buy a BBB bond or even lower credit quality, you will get a higher credit spread. And that credit spread can widen or narrow depending on the fundamental conditions of those borrowers. So we really look at these borrowers closely. We have our own credit research team to ensure that the credit spreads are expected to tighten or avoid those that are deteriorating credits.
Bertrand has covered most of my points. But maybe I'll just add a few other things. Obviously, the elephant in the room these days in news is Trump, right? Or rather tariffs. And obviously that's going to have a lot of impact on markets, including bond markets. So we're watching 2nd April, right? Is he really going to come up with his reciprocal tariff? Now, the key question is, what's the impact of tariff on interest rates? There are two opposing forces, right? Tariff is bad for growth, global growth, because if China and the rest of the world were to retaliate, that's bad for everybody. Now, when you have lower growth, interest rates tend to drop. So that's number one. On the other hand, tariff is inflationary, right? Because things are going to be more expensive, right? Your importers, or sorry, your exporters aren't going to pay for the tariff, right? The consumers will end up paying for it. And when that happens, inflation will go up. When inflation goes up, the Fed cannot be cutting. They need to stop cutting or maybe even raise rates one day. So with inflation, or rather with tariff and therefore inflation, interest rates will go up. That's the second point. So first point and second point is actually contradictory, right? Because one will cause interest rates to come down, the other one will cause interest rates to go up. So in a way, the market is now trying to decipher, and it really depends on what Trump does. I'm just saying all this, that these are things that we still worry about. That said, our house view is that eventually we do think that the growth side will be more important. In other words, we're more concerned about the impact of growth. On the inflation side, the question is whether or not would it be temporal, right? Because inflation in theory is just a one-time measure, right? Once everybody is paying higher, the next year, if it stays at high, it doesn't mean that inflation is high. But that said, there's a lot of many ifs and buts surrounding this point. But these are the things that we do consider. But that said, these funds here are short duration, and by short duration, it means that we buy bonds that are up to 5 years, and that's not going to be that sensitive to interest rates. The credit component, as Bertrand mentioned, that has the additional yield, and when we have the additional yield, that gives us the buffer to cushion us against the interest rate volatility that can hit the bond. So it's for that reason that we keep the duration short, so that at the portfolio level, you will see that the fund will not be as volatile as, let's say, a 10-year bond fund. So maybe I'll stop here.
So maybe, Tochi, you spoke about the yield curve being very flat right now, and hence, not a lot of difference between the money market fund and the enhanced liquidity fund. Can you share a little bit more with everybody on, how does the yield curve work, like how, and where is it expected now to move?
Okay, so maybe I start from something more fundamental. Yield curve is essentially the cost of borrowing money at different tenor. So if a government or a company were to borrow at 1 year, it it borrows at a certain rate, and if it borrows at 10-year, it's another rate. In normal environment, the yield curve is upward sloping, meaning that if you borrow a 10-year loan, the company if the government were to issue a 10-year bond, normally it has to pay higher. So that's a normal yield curve. But because of COVID and inflation, the Fed had to hike rates. You have a situation where the short-end rates were very high, right? And that caused the yield curve to be inverted, meaning a 1-year rate is much higher than a 10-year rate. That's an inverted curve. But as you know, we are post-COVID. Fed already hiked more than 5% in 2023. And in fact, they have been cutting, right? Fed has cut 1% since last year, right? So that has caused the short-end rates to come down, such that the curve from very inverted right now it's kind of flat, a little bit normalized. Will it normalize further? It depends on whether Fed can cut even more. And that depends on Trump and his tariff and his other measures. Fed is now in this situation where they're supposed to be cutting, right? The unknown here is what is Trump's policy on economies and inflation. That is an unknown, right? None of us know, neither does the Fed. We're all waiting to see Trump's action and the impact on the economy. But so only if inflation were to come down, can Fed cut, then will the yield curve normalize? So I think that was your question. Yeah.
So, we talk a lot about the decisions that the Fed makes in the US on interest rates. For you, since a lot of the underlying investments here are either in SGD or in more nearby currencies, how quickly or in what time span do you see those things translating over here? Like, how close is every market to that reality of the US?
I think directionally global rates move together. So it's if US interest rates are going higher, Singapore interest rates will also be going higher. It's just a matter of the translation on how fast. I think as an example, in the fourth quarter, when Trump uncertainty was all over us, I think US 10-year went up by around 0.8% to 0.9%, but Singapore interest rates didn't go as high as the US. So we only went up by maybe around 0.3%, around there. So it's more about the Singapore interest rates, less volatile, but we do follow the US interest rates directionally. I think it's more because of the different fiscal dynamics in Singapore and the different liquidity conditions. But directionally, we do follow US interest rates.
Maybe I could add, in relation to these short-dated, like money market or enhanced liquidity, while by and large, as Bertrand mentioned, Sing rates does correlates very well with the US rates. In Singapore, there's this domestic factor, which is MAS policy. That's one. Second factor would be on the domestic liquidity situation. In the last 2 weeks, for example, we've seen rates drop quite a lot in Singapore. And then this week, somehow the rates shot up. In the early episode when it dropped, we suspect the banking system was just suddenly flush with a lot of money. And this week's reason, I would think, is it could be because we're having this long weekend ahead of us. It's a quarter end, and somehow during quarter end, liquidity tends to be tight. So that's the only thing I can think of. Now, what does this mean for us, right? Now, you say, money market fund is such a boring fund. How does this affect us? It does affect us because, so for both money market fund and money market fund and enhanced liquidity fund, we don't just buy Singapore short-dated bonds because, one, there's not enough. Number two, there's not enough yield, right? We want to get something better. So we do buy, in fact, let me just try to think, we have about less than 60% in Singapore. And the rest are in US dollars and other currencies. As I said, we hedge back the currencies, there's no risk. But to even buy something that's non-Sing, we need to track very closely the hedging costs. And we do that in the FX market. So two things need to happen, right? First of all, we need to find a bond that's yielding enough. And number two, we must check the FX rates such that after hedging back, the yield is better than what we get in Singapore. In theory, this is pretty straightforward, but in execution, it's a bit tricky because you need to be able to catch the rates at the correct time. So all this volatility I mentioned does bring about challenges. At the same time, when it's volatile, then there could be times when it's in your favor. So we do look out for these things to capture the yield so that we can get a better yield for our funds.
So maybe last question before I open it to the floor is, for you, what is the role that these funds really play in cash management, and why people should be thinking about them, and beyond, the savings account and the multiplier things that the banks have?
I think for me, the role of these funds is, one, to enhance yields on your existing cash. The second part for me is it's a core allocation of a diversified portfolio, so it should be part of anyone's portfolio, 5%, 10%. The second part is, the third part for me is more like when you hedge, you want to hedge risk. There's a lot of uncertainty out there. Interest rates have been going up and down. Your equity portfolio, you're concerned about it declining. And so you hedge your risk by using cash funds. You increase allocation in cash and underweight some of the riskier allocation that you've had. So that's how I would view cash funds.
A very similar answer. We manage money for institutions. And these institutions in their portfolio, they do use our funds as building blocks. So in other words, you have the same access as the institutions. So how do we use it? In the case of short duration bond fund, that tends to be part of the core portfolio to form the anchor, or to have the stability for the portfolio, while the other part of the portfolio will take some risk. Right? A good example would be, let's say, a 70-30, where 70% will go into a short duration bond fund, the 30% will buy into an equity fund. In that sense, you do get the diversified portfolio. In some of our balanced fund, we do employ this technique where we buy our own funds to create a portfolio. In the case of the money market funds, we do have institutional clients who buy into the same fund because they find that this is a more efficient or cheaper way of managing their cash or liquidity. The fund is T+1, so that's as good as it gets. And it does give a better yield than their fixed deposits. Some of the institutions we speak to, they used to buy T-bills or MS bills, but they are charged a fee. Right. So in our case here, by going through our funds, it's a cheaper way of getting access to liquidity fund. Don't forget, if you buy a T-bill, you can't quite liquidate it. You have to wait for, let's say, 6 months. You can liquidate this in T+1. And just to add on one point, we spoke about liquidity, and recently there's some news about this liquidity thingy. Why is it that you need T+1 or T+3? It's because at the fund level, when we trade bonds, we need time to settle. It's like you buy a stock, right? You buy DBS. You're not going to get money immediately. You're going to get it maybe T+3. Same for bonds. We buy a corporate bond, it's T+2 or T+3. We buy MS bills, SGS is T+1. So it's never instant.
The money is not meant for your day-to-day expenses, which is why also we usually say 1 to 2 month expenses can be kept in the bank account for instant liquidity, and then the rest, you can deploy other strategies. With that, maybe I'll open questions for the floor.
So I'm more interested to know about the currency hedging, now with the more black swan events coming up, like Indonesian rupiah falling to the historical low, and you said it's diversified across different Southeast Asian markets. How would you prepare for such super black swan events in your portfolio? How would you actually hedge those unanticipated risks beyond the FX trades?
Well, if you thought about things like Indonesia, first of all, when I spoke about buying into other currencies, we have to be comfortable with the bond that we're buying, right? So in this case, we don't buy any IDR bonds. We buy into Australia, Japan, China, Hong Kong, so kind of more developed countries. Number two, the moment we buy the bond, we straight away hedge the risk. So I buy a 3-month paper, I'll hedge away up to that maturity of the bond. So even if the currency crash, I'm okay.
I think it's the same for us in the sense that we do focus on a more developed market currency. So in our portfolio, we hold Sing dollar, US dollar mostly, and Australian dollar bonds. And at purchase, they are immediately hedged back to the Singapore dollar. So we are exposed to hedging costs, and that can have some volatility on a month-on-month or a 3-month basis. But all in all, this hedging cost has been more manageable. And as Toche mentioned earlier, we must make sure that our yield is high enough to cover hedging costs. And so in the end, if that's not going to deliver us at least similar to a Singapore dollar bond, then we'll just buy at least Singapore dollar bonds.
So a very basic question, basically. We've spoken about money market funds. We've spoken about equity funds as well. Is there something intermediate, or is it like something like a medium risk between equity and money markets? I know historically the funds that you build is a percentage of these two categories of funds, you want to call it, right? So is there any other fund basically right at the low level that you can classify as a medium risk, or is it always in the market, it's just the money market bond funds and the so-called high risk equity funds?
So I can start off and then feel free to share. So actually part of our core portfolios is exactly this. So actually we have 12 levels of risk that you can choose from. And that's a combination of equities, bonds, and depending on the risk that we want to stabilize the portfolio for, the duration of the bonds also matter in it. And so the portfolio is a mix of equities, bonds, and gold, because we believe also in gold as a really important hedging asset class. And, you know, for us, clients can go from the lowest risk spectrum of almost close to 100% bonds portfolio with some gold in it to a almost 100% equities portfolio. I think our highest risk portfolio still has 6% or around a single digit gold allocation, and the rest all equity. So, but again, sectorially and geographically allocated. And so yes, so exactly to your question, it's not 1 or 100 level of risk. And that's really important, you know, to be able to think about personal risk appetite, but also time. So a 5-year goal versus a 10-year goal versus a 20-year goal. You know, the duration matters a lot on what volatility you may be able to manage through. And that risk is managed via a more personalized allocation of equities, bonds, and gold. No, so we have always had gold as part of our core asset allocation based on, you know, whether we are in inflationary growth or whether we are in stagflation. It's deployed at different levels, so whether we overexpose or underexpose on gold. But since the beginning, gold has always been part of our asset allocation, and probably that's one of the things in which our investment strategy is a little bit unique from your traditional 60-40, 80-20, you know, type of equity bond, because we utilize gold as a hedge. You know, since the beginning. some years it's really there to just provide a balance. Some years, like last year, gold did 26%. So obviously it was a huge add-on to the returns, and even this year gold has performed really well, despite the rest of the volatility in the market. Yeah. Anything that
I think I think just from a fixed income perspective, within the fixed income universe, there's a different levels of risk spectrum. You have your short duration bond funds, you have your medium duration bonds, your full duration bonds. Like we have bond funds that have duration of 8 years, and this short-term bond fund that we have is 1 year. And you can also increase risk on the credits risk spectrum. So we have investment grade, and then you have high yield. So there's a non-investment grade high yield bonds that can give you a different risk return profile. So even within fixed income, there's a lot of things that you can do, and you can even have a multi-currency kind of exposure where you're adding in currency risk. So it really depends on the risk appetite that you have: duration risk, credit risk, and currency risk.
And especially, very simple, like whether you're taking bonds, whether in government or in corporate, from advanced economies versus emerging economies, and that's where the credit risk spectrum yield is higher. So emerging economies bonds, whether they are on the corporate side or the government side, will deliver a higher yield because there is a higher risk attached to them, versus if you're taking U.S. government bonds like the U.S. Treasury bills, or even the Australian, and just like that, the MAS bills or the Singapore government securities. As you saw, the rate right now in the auction is around 2.8%, because this is a very safe economy. And whereas, in India or in Indonesia, the yield even from a government bond would be much higher.
Is your money market fund also consider the cryptocurrency as an investment, some part of that, to leave some exposure or to higher gain, looking for the higher gain? That is my one second.
I didn't quite hear the...
And my second question is that whatever financial institute make, like your financial institute make the gain, what percentage is passed on to the retail investment actually? Is it when they say it's 4%, 5%, but actually you make a lot of money out of it from these investments? So is there any specific way what is passed on to the investment? Like I invest 10,000, so yes, the rates are, gains are already published, but is it really actual gain you recover, or it is just some portion is passed on to us?
Everything is passed on to you, other than the fees, which is published, right? Everything is passed. We're not allowed to profit from it. MAS will not allow that because we're not running a proprietary desk. So this fund is not owned by us. We are the manager of the fund. So in theory, your money, your assets are not part of our balance sheet. So if we make money for the fund, it doesn't go to us. It stays with the fund.
Regarding my first question about the cryptocurrency,
no, we don't. Well, Lion, we don't buy cryptocurrencies.
We currently don't. Yeah.
So we definitely for cash that you want to make sure is there when you really need it. That's not even in our StashAway house view. That's not something that we would recommend to look at towards cryptocurrency. And in fact, overall, we advise people that to not cross 5% of their net worth as exposure to cryptocurrency, and think very, very carefully about it and understand the asset class. But yes, as part of, like for example, as part of our cash management solutions, that would definitely not be something that would make sense for us. But also in Singapore, for example, for retail investors, that's considered a very high-risk asset class, and we cannot add that as an asset class into portfolios that we provide for retail investors.
So I use the simple SGD, which I believe has underlying assets in Lion Global. We're aware that seems to be market volatility is seeming to push rates up. However, I've noticed that the simple returns went down from 3.3% to projected 3.1%. Trying to understand, when the market seems to be under inflationary pressure, at least assuming inflationary pressure, and markets usually price it in, why is simple then going down from 3.3% to 3.1%, please?
Okay. So yeah, I'll take that. So as you know, since the peak of inflation about 2 years ago, inflation started to come down, and back then Fed already hiked rates by 5%. When the US inflation starts to come down, the Fed has been cutting rates since, if I recall correctly, last year September, and they cut 1%. Since then, interest rates have been falling. Singapore rates has also been falling. So that naturally results in the yield of the money market fund and enhanced equity fund. The yield therefore will have to drop. Right? So the yield has been falling. Was at our fund level, the two yields at the gross level, the yields are around 3.3 and 3.4% today. I mean, it was as high as, I think, 4% maybe a year ago. It's really reflecting the fact that Fed has been cutting rates because inflation has been falling. So, and as a result, seeing rates have been falling, and the bonds, the yield of the bonds that we've been buying has also been falling. So that's why the yield of the fund has been falling.
So also the rate that you see is net of all fees, as well as we receive trailer fee rebates, which are 100% returned to clients, and that's added back into the yield projection. So it's actually the actual yield, not a gross yield that we advertise, and that's calculated directly from the yields of the two individual funds that we use from Lion Global, and on a weekly basis we receive information on how the yields of the funds are working, and we recalculate what would be the projected rate, and on a weekly basis, if there is a change, we update the change immediately. So since it's meant to be a very liquid fund for immediate cash needs and all, we want to make sure that the yield is always projected to the latest information, and therefore it's managed on a weekly basis. So, which is why as soon as we see a yield drop coming from the fund manager, we will immediately change our projected yield as well within the same week.
And just to add, yields have been dropping. I mean, you look at MAS or TBO yields, right? TBO yields have now dropped to 2.75, as I mentioned. I mean, back then it was 3, for a while it hit 4%. It's no longer there. And it's not just TBO yields, right? Your FD rates, even some of the banks' special saving rates, right? Last Friday, OCBC just dropped their special, I think 4.6 something, the 360 account. OCBC had this special account, was at 4.6, they dropped it to 3.3. So that's a reflection of lower interest rate, the environment we're in.
I have 3 questions. Should I go all first or one by one?
Just shoot all 3.
Okay. So maybe first 2 are for StashAway. Why do you choose Nico and Lion for your money market funds?
I think, look, there are certain things. So for us, cash management, as you've heard from the two gentlemen, there is deep knowledge that you need to be able to truly ensure that the yields are delivering to the needs of the customers, right? And traditionally, these have been things that institutions have used, and also for us, what is very important when we partner and we do our due diligence on the fund. And please, I'm not from the investment team, core investment team side. But our CIO, Stephanie, is also usually happy to take these questions. But for us, it's really important to understand what are the core needs and what is it that we are trying to cater to our clients, and who is the best to be able to cater that. We're not attached to any fund house, and so, we have the liberty to truly do due diligence on, a lot of funds and pick the right ones that fit the needs that we are trying to deliver of our customers. For us in the money market fund, the track record, the rigor with which it's managed, the fact that, we receive information on a weekly basis. We have a very close relationship now. It's been 6 years that we've had this, close to 6 years we've had the product. So yeah, and it's always perform to what has been the promise. And for us, that's really important to be able to, deliver our own company performance promise to our clients. So yeah, I don't know, more than that I wouldn't be able to tell you about fund level due diligence, but yes, we do look at track record, people who understand the needs locally of the countries, yeah.
Maybe I give you a simple answer. The Sing dollar money market or short duration fund, you want a Sing-based house. Nico is actually the DBS asset management. I'm from OCBC. Singapore, there are only 3 banks. So 2 out of 3, not too bad, right?
Thank you for that. The other question I have is, I heard from you that T+1 we can get back, liquidate our investment, right? Then how come we take until T+2, T+3 for the money to show in our bank account?
So because we don't have just one fund as part of the portfolio. We have 2 funds, and in the Simple Plus we have multiple. Okay. And so the enhanced liquidity fund has T+1. So for Simple we have 1 to 2 days. So that's our promise. We keep a small buffer in it just to make sure that we are not over promising to clients, because again, from a cash perspective, we want to make sure people know what to expect. So yeah, but to be honest, most of the withdrawal, in fact, most of the withdrawal will happen by next day if the withdrawal has been initiated like before 12 or 2 p.m., something like that. Yeah.
Based on personal experience, I had a T+3 withdrawal 2 weeks ago from Simple Plus, which coincides with chocolate finance at the time.
No, so Simple Plus will be around that, because the short duration bond funds. Simple, if there are public holidays in the middle, or the timing, so usually we say 1 to 2 business days. Or if we don't have we haven't verified the bank account or things like that, we are also required to do those things. So if certain things flag up over there, but if your bank account, withdrawal bank account is verified, it's within the limits.
This is repeated withdrawal.
Happy to take it.
Okay. And then my last question is for these 2 gentlemen. I know the funds in the money in the money market funds are not guaranteed, right? In what situation will our principal suffer a loss? And what are the early warning signs, right, that we can see and we can take the money out?
For Simple, which is money market and enhanced liquidity, from a interest rate volatility point of view, you won't, because of the way we mark the portfolio. The way you can lose money is if there's a default risk. Meaning we buy a single A bond, but suddenly the bond go under. So that's the possibility. Although I would say it's slim, but as in investments, sometimes you never know. Lehman was a single A bond. It went belly up. For our short duration bond funds, we can have volatility. And 2022 was the year where all the bond funds were hit. So you have to look back at 2022 to see how much we dropped. So my fund dropped, I think, 3.9%, about. I'm not sure about Nico's.
Less than 1%. So because it's a shorter duration asset class. Yeah, it's for short-term bond funds, different from money market. Money market fund more or less guaranteed because 3 months. What's the worst thing that can happen? Default, right? So that's the only worst thing that can happen for a money market fund, default. If you're holding like investment grade, high quality, so capital market loss is minimal. But for short-term bond fund like ourselves, our risk is really interest rate risk. And when interest rates rise really sharply, like what happened in 2022, then that's when you can have negative returns if you hold it during that period and sell it during that period. So you have to hold it and ride the interest rate movement and have the coupon recover the interest rate loss.
Thank you.
Which is actually why the Simple Plus, which has short-term duration bond funds, we recommend that it's for money that is not needed for minimum a year, just so that in those cases, the time horizon matches when the coupons actually will pay out and make the investment whole.
Thank you.
So the BlackRock managed portfolio is it's actually, so it is subjected to rebalancing, and BlackRock does an optimization of it every quarter. So they review the asset allocation on a quarterly basis. Usually they are not very large changes in asset allocation because it's done more periodically. So yes, on a quarterly basis, they will re-optimize. But in the meantime, if any securities do cross certain thresholds where they are beyond their, more than, I believe, 20% of from where they are supposed to be, the product will auto-rebalance. But that's a very rare scenario, just because BlackRock re-optimizes every quarter. Usually, you'd have to have really a COVID type of event, and you know, and they obviously look at that very carefully. Similarly, because they are bond funds, they do look at re-optimizations, not quarterly, the same way as the presence of equities, but usually on a 6-month to 1-year basis. Yeah. Because the duration of the bond funds under the JP Morgan product is a little bit longer. Yeah. So the one managed by StashAway, so historically we have had on an average a re-optimization in 15 months, but our re-optimizations are very clearly tied to the change in the what is the economic regime. So if the regime has moved from, for example, the last re-optimization was when the regime moved to inflationary growth back from stagflation. That's when we re-optimized. So we don't re-optimize our strategy. The management is a little bit different from BlackRock, where they do smaller re-optimizations on a quarterly basis, because they manage an equity bond ratio, and that's the leading strategy behind it. Whereas we are managing towards a risk level. So we don't tie ourselves in the StashAway asset allocation strategy to a very fixed equity, bond, or gold ratio. It really depends on, if we are in stagflation, you know, the expectation is different of equities versus bonds, and therefore the asset allocation will change to maintain the risk level. So that's the big difference, and therefore, you know, I think our last re-optimization was in April 2023. About 2 years ago, and since then, we've been in inflationary growth, and so there is no reason for us to re-optimize. But this is something that our investment team looks at with real-time data, and so if they see that we are moving towards a different regime, which usually comes from indications of inflation and growth, yeah. Yes, if the signs are of a recession coming in, then obviously that will most probably trigger a re-optimization for us. But that's data that's managed real time. Yeah. So we don't, so yes, we change asset allocation, and obviously when we see the data changing, we optimize in a very timely manner, and the tech half of our company helps that we are very efficient in it, so that we don't go into loss realizations and things like that. So usually, we will re-optimize within just a couple of weeks of when this information is updated. But we don't see it as, so maybe the best way for me to explain is we don't see it as a loss realization and all, because it's always about positioning your portfolio for what is ahead, rather than trying to leave it in what could very quickly be behind. So we don't realize gains in terms of, because it's not an actively managed portfolio. So we expect that in a certain economic regime, asset classes will behave in a certain manner. And therefore, because you are in a diversified portfolio, your equities, your bonds, gold, they are expected to behave in a certain manner. And so what we look at is, are there any other sectorial changes, differences, because it's not just diversified over, one equity, so we also split the S&P 500. We are not just in one. We also have equal weight S&P 500 versus the market weight S&P 500, and then as well as certain sectorial ones. So you don't realize a lot. So true loss is only realized when or true gains are only realized when you actually pull yourself out of an investment. You will see your portfolio up and down based on the everyday value of the equity. So yes, the premise of every re-optimization is that if we re-optimize, let's say, from 5% gold allocation to a 9% gold allocation, it's because, in that economic regime, gold as an asset class has historically helped add to portfolio's value rather than subtract from portfolio's value. So we don't keep any of your funds in cash. We keep as little as 1% in cash just to manage operations efficiently. We do not hold cash ever. So in that, that's not a very optimized way to manage your money. Also, in sense of passive investing, while we do strategic asset allocation, where it's very much a passive investment, and in a passive investment, leaving a cash allocation is only going to be a deterrent on your overall long-term portfolio gains. Yeah. So we only keep 1% of your portfolio in cash, purely for operational purpose. Yeah. Not the best person for these, but if I'm, one of the client engagement teams can take the questions and probably come back to you with more detailed answers.
What is StashAway's total asset under management now? Because I think it was announced when it crossed 1 billion many years back, but since then it's quiet. I'm not sure what.
So we've grown a lot, but it's
Right.
not a number we share publicly, I'm afraid. It's above my pay grade.
Okay, another question is, for this cash management fund, you already disclosed the composition, Nikko Asset Management and Lion Global. What difference does it make if we directly invest in these two funds in other platforms? We can save your management fees. Can you give a breakdown of how the management fees, the treasury fees, whether you are actually investing in the institutional tranche with a lower management fee? That's where we can benefit from that.
I wouldn't exactly know the different fee structures of different platforms, but I do use another platform to buy our own fund. But I said they do have their own annual platform fees. So different funds, different structures have their own fees. But you cannot go to us directly. You have to go to a platform that can, some of them even have front sales upfront charge or a platform fee on an annual basis. So it depends on who you're buying from because they will have different fee structures.
It's the same. It's the same for Lion.
Yeah, and actually our fee structure is very, very transparent. So you know exactly, the trailer fee rebate that we give back to you. You can see so this is why we always put the projected rate net of all of the fees, because in cash management, that's what is important for people, is to know what am I actually going to expect as returns rather than to have to do the math of all of the fees. So for you, that's actually very easy to compare. Yeah, and hopefully, obviously we also hope that we bring a great experience in terms of you're not having to manage your money yourself, the time spent, other ways to spend your time, but we are very transparent about what our fee structure is, what the projected rate after that fee is. People do need to know that how much they are paying. Absolutely. Yeah, so our volumes are big enough to be in institutional share class, yes. And that's, again, hopefully, when you see the projected rate, all of that benefit is actually delivered in that projected rate.
Banks not offering this cash management solution to retail. I was just wondering, I think you don't want to bring in the banks, but just...
I can't speak on behalf of a bank, but early on, I think they were charging banks FD rates, right, which is at 2.8. And if banks can get away with giving low rates, why would they not continue to do that? You know what I'm saying? So that's my guess. I can't say for sure why banks aren't, doing what StashAway is doing. Yeah. Because banks earn money from making the difference between what they charge on loans and what they pay on deposits, right? And bank wants to make the difference. In other words, banks want to pay lower deposits, low FD rates, and earn the spreads. If they pay higher, their margins will be narrower, and that's lower return for shareholders. I'm just stating something fundamental, right? Not that I'm from a bank. Yeah.
I think what is important is to make sure that you understand the full structure of the fees, because the instruments have a cost. It's not just the management fee on top. and at the end, it all comes out of the projected yield, whether that's in money market funds, short-term duration funds, or other fixed income funds, because those are very yield. Like the yield is there as part of the product information, right? So hopefully that information is clear to everybody to be able to understand.
Can I just make a comment? Or rather, okay, early on we said when we manage investments, when we buy bonds, we buy different currency bonds to hedge it back. This is fundamental finance, as in interest rates around the world are different. US rates are higher than Singapore rates. Right? So if I buy a bond in US dollars, I need to hedge it back to Sing, I have to pay a hedging cost. Today, hedging cost is about 1.8%. In other words, if a US dollar bond is 5.8%, in Sing terms, it's actually 4%. So when you're offered a US dollar product, which you did mention, bear in mind that a dollar product that's giving you of a certain rate, it cannot be the same rate in Singapore because there's a hedging cost involved. So when you buy, make sure you know what you're buying. I just emphasize that a dollar rate cannot be the same as Sing rates because of interest rate differential. I'll just end my comment there. Thanks.
No, and this is why also just looking at the top line number, the yield number of a product is not the entire story. So important to see the currency, important to see the underlying, whether it is exposed to market volatility, not exposed to market volatility, and therefore what is the right use for it. I think it's the fifth time. Any question? No? Sorry? How? Above my pay grade. Today I will respond with above my pay grade. No, but I mean, this is our largest base, and we are fortunate to have in multiple thousands of users. So yeah, one day. Well. Thank you very much. Thank you for the participation, for the questions. It allows us also to think about what more we can do, and most of all, thanks to the panelists, to Bertrand and Tochie. And please, if you haven't had the chance to have some dinner, please do stay. But thanks very much for joining us today. Thanks.
Thank you.